Types of taxes include duties, levies, income tax. Income tax. You can use incidence theory or income theory to categorize taxes. Now, according to income theory, a taxpayer's percentage or total income determines how their taxes are classified. Now, this theory divides taxes into three categories: progressive, regressive, and proportional. On the other hand, incidence theory classifies taxes according to the locations of their incidence. Now, this theory divides taxes into two categories: direct taxes and indirect taxes. We delve into each tax theory very soon. Proportional tax system. Now, the tax that each taxpayer pays on the basis of the same ratio to the amount to be raised as the value of his property bears to the total taxable income is known as a proportional tax. Put another way, a percentage income. Consequently, as the tax base grows under the proportional tax system, the tax rate as a percentage stays constant. Progressive tax system. Progressive tax system is one in which the amount of tax collected increases as income does. Now, when the tax rate increases or rises in proportion to the amount of income or wealth being taxed, it is said to be progressive. Higher earners are disproportionately affected by a progressive tax income. Regressive tax system. A regressive tax is one whose design reduces the revenue yield as the assessed value of the property increases. Now, in a regressive tax system, a high-income person pays less tax than a low-income person. Direct tax system. The incidence of tax is of vital essence in classifying tax into direct or indirect taxes. A direct tax is one which is demanded from the very persons who it is intended or desired should pay it. Indirect tax system. Indirect tax system is borne by a person other than the one from whom the tax is collected. Now, in other words, indirect taxes are those which are demanded from one person in the expectation and intention that he shall indemnify himself at the expense of the other. In a nutshell, indirect taxes are those which are imposed on commodities before they reach the consumer and are paid by those upon whom they ultimately fall, not as taxes, but as part of the market price of the commodity. Examples of indirect taxation are value-added tax, VAT, stamp duty, excise duty, customs duty, and sales of purchase tax. Duties. In Nigeria, categories of duties that can be imposed by the government are stated in the second schedule to the Constitution of the Federal Republic of Nigeria, 1999. The duties are custom and excise duties, item 16, export duties, item 25, and stamp duties, which is the 58th item on the exclusive legislative list. A duty is a tax you pay on things that you buy, especially those that are bought or imported into the country. Stamp duties are one of the oldest taxes. They are taxes paid to the federal or state government on documents for the purpose of conferment of legal approval or authority. Now, stamp duties may be specific or ad valorem taxes imposed upon instruments otherwise called written documents. Import and export duties. Apart from stamp duties, which can be legislated upon by both state as well as federal legislatures, other duties are exclusive for the federal government. And even on the stamp duties, it is only the execution of personal instruments that can be legislated upon by the state government, while the federal government legislates on stamp duties executed by corporate and residents of the Federal Capital Territory, Abuja. customs, and excise duties. Government taxes on specific items manufactured, sold, or consumed domestically are known as excise duty. Export duties. This is a tax on items that are imported and exported. Even though it is a goods tax, it is one of the most efficient indirect methods the government may raise money. Import and export taxes are imposed in a similar manner to excise duties to regulate the production and movement of specific categories of commodities. Now, lower percentages of importation rates will stimulate the flow in of such commodities, while higher percentages of importation rates can be used to check importation and redress trade imbalances between nations.